Good morning, Vanessa. Good morning, Katie. We'll wait a moment here to see who joins us as we just plow ahead to the next chapter. Justin, how you doing?
Well, Bob, how you doing?
Good, good. Will we see you tonight, Justin?
Most likely, yes.
Okay.
Hopefully I won't be the only one.
Well, we know we have at least one other student who's going to be there, so be a bigger crowd than last time.
Big deal.
Yep. Okay, we have three guests so far? I guess we can begin with that. And I'm going to share a screen. You see this PowerPoint, Justin?
I sure do.
Okay. All right, everybody. Good morning, class. This chapter is going to be your first real big challenge in this. I mean, not that any of this has been easy for you, but when you come to the adjusting entries, there's always a learning curve. And let's fight our way through it today, and we'll have plenty of time to review this concept going forward. Okay, I see Mark joined us. Hi, Mark. So starting with adjusting journal entries, what you're going to learn is that when a company prepares the trial balance at the end of the month, by definition, it is incomplete because there are certain transactions that can only be recorded when the month has ended. So January 31st comes and goes. You show up the next day at work, and typically you might have 2 days, 3 days, maybe a week at the most to perform what's called the closing process, where you prepare all these adjusting journal entries and then deem the trial balance fixed and adjusted. And from that, you can go and prepare your financial statements. So let's see what we're talking about here. Prepare end of period adjustments. We have to worry about things like equipment wearing out. You're going to learn about depreciation expense here. We're going to write a journal entry every month to record what's called depreciation expense on equipment and buildings and other fixed assets, vehicles. Remember, we had prepaid insurance and we had supplies. And if you recall, in chapters 2 and 3 and 4, we put those spending items into the asset category. Here, the adjusting entry is required to find out how much of that asset we consumed and record that consumption number as the expense. Since these events have not been entered into the accounting system, adjusting entries would be made. And then another adjusting entry is to accrue payroll. You get paid once a week, and you worked on the 29th, 30th, and 31st of March. Well, you're not going to get paid for those hours until maybe April 7th or 14th. But you worked those 3 hours, those 3 days in the current month of March, and that requires an adjusting journal entry to record that payroll. And these are guided by the revenue and expense, the matching principle. The matching principle is one of the GAAP principles. What do we match? Revenues and expenses. And that's always a question on any accounting test at this level. The matching principle says we have to match the revenues with the related expenses. And that's what these adjusting entries are all about. The revenue recognition principle. We know this. It states that revenues should be recorded when earned, regardless of when the payment comes from the customer. Same thing with revenues are considered earned when a service is provided or the product sold. Same thing with expenses. Expenses are recognized when incurred, regardless of when cash is paid. The month of March comes, March 31st, and you don't have the electric bill yet. Well, You can't wait for the electric bill to come in the mail. You have to record something. So you have to record an adjusting journal entry to accrue that expense. And expenses are generally incurred when the goods and services are received or assets consumed. And here we go with the matching principle. What do we match? Revenues and expenses. By doing that, it gives us the best measure of net income and the most accurate financial information we could have. A fiscal year. I think we know that a fiscal year can be any 12 months. A lot of companies, they're just on a calendar year, which I guess makes it a little bit easier. But some companies, like General Mills, that General Mills sells cereal, okay? General Mills, their fiscal year excuse me, their fiscal year follows the farm cycle from planting to harvest. Department stores like Nordstrom's probably, their fiscal year might end at the end of January or February because they want to get those financial statements out right after the hot month of December. So a fiscal year is any 12-month period used as an accounting period. Okay, let's take a deep breath and start with some adjustments, okay? Let me preface this by saying adjusting journal entries are a search for unrecorded expenses. Adjusting journal entries are a hunt for unrecorded expenses and a couple of revenues, but let's talk about expenses. No cash will ever appear in an adjusting journal entry. The reason I chuckle when I say that is inevitably a couple students, get a little bit mixed up on a test and they throw in cash. No, these entries are always going to be a debit to an expense and a credit to something else. So let's recall that $80 worth of supplies that Mitch bought during June. Okay, he bought those supplies at the beginning of June when he started his business, and we debited them to the asset account called supplies, prepaid supplies. That's an asset. So now it's the end of the month. Mitch goes into his storeroom or whatever, and he sees that there are only $20 worth of supplies left on hand. That means he used $60, and we're going to have to record an expense debiting supplies expense for $60 to increase the expense and credit the asset supplies by 60 to bring it down to the new balance of 20. Unless there's an adjusting journal entry made, $80 of supplies are going to be still showing on the balance sheet. Well, suppose we failed to do this. What would happen? Assets would be overstated and supplies expense would be understated. So your net income naturally would be overstated. So $80 purchased during the month, less 20 remaining, gives you an adjusting number of 60. We're going to debit supplies expense and we're going to credit prepaid supplies, okay? And anybody have a question or I'm going too fast or it's not clicking quite right, you jump in here and maybe we can help you out. And maybe seeing it in the form of T accounts in your general ledger. And this is journal entry. Here's your journal entry. You debit supplies expense, you credit the prepaid supplies, and there it is in your general ledger. That's an expense, $60, and we credit the supplies, okay? We credit the supplies. Come on, come on. Oh, for heaven's sake. Let's talk about another prepaid insurance. Prepaid insurance. When you buy an insurance policy, by definition, it's an asset. It has to be an asset because you haven't gotten any coverage at the time you bought it. But it will provide insurance, in this case, for the next 10 months. That says 200 on top, that should be 700. During June, Mitch paid $700 for a 10-month policy. Coverage begins on June 1st. So now June 1st is ended and we have to do our adjusting journal entries. Well, that policy gives us coverage of $70 a month. That's how much we're paying for that. We paid for that policy. It comes out to $70 a month for 10 months. So we are now going to debit insurance expense for $70 and credit the prepaid insurance for $70. And here it is again in the form of your general ledger. You debit the expense and you credit the asset. So you can see one of the 4 categories, if you will, of adjusting journal entries deals with prepaid assets and how to turn those into expenses at the end of the month. Okay, so that's one category of adjusting journal entries, crediting the prepaid and debiting the resulting expense. Here's one I bet you're familiar with. You have all been out in the working fields. Most of you are working right now. I bet all of you are right now. Again, Rohan paid his part-time employees $1,650 on June 27. On top, it says $650. It should say $1,650. Anyway, Rohan paid his people $1,650 on June 27th. Okay, well, that takes him up to that date, okay, close to that date, $1,650. That's history. We've already processed that much of the payroll. But on June 28th, 29th, and 30th, those same employees earned an additional $400, but they're not going to get paid for another week or 2. So that additional wage expense has to be recorded as just that, salaries expense. In other words, the hours worked at the end of the month for which you're not going to get paid until the next month, that is an expense for the current month. So here's what we're going to do. We're going to debit wages expense and credit an account called accrued wages payable. It is a payable. It is a debt, and that debt is due at the end of the month. If you quit your job, they have to pay that $400 right there on June 30th. If they let you go, they laid you off, they have to pay it. If they went out of business that day, they have to pay it. So it's a legitimate liability and expense. And here they're showing it again. We got the liability going up along with the related expense. So accruals. Historical cost principle. Every asset on your balance sheet is recorded at the actual cost. That cost remains on the general ledger as long as the business owns the asset. And this is the important concept to understand, everybody. No adjustments are made for changes in the market value of the asset. For example, your great-grandfather opened up a business in Santa Barbara and he bought 10 acres of beachfront property in Montecito. Well, he paid $10,000 for that property back in 1920. The business is ongoing, and that property is now worth not 10,000, it's worth 10 million. It will still be carried on the financial statements at $10,000. It's part of a GAAP principle called conservatism, which states that you never anticipate gains and you always anticipate losses. Okay, so everything on your balance sheet is at whatever you paid for it. The assets are always at historical cost and may have no relation at all to what the market value is. So we're going to talk about fixed assets. Fixed assets, long-term assets. These are the big ticket items. These are your vehicles, buildings, big equipment, furniture perhaps. And what we're going to do when we buy a fixed asset, we have to assume a useful life for it. Useful life, and that's an accounting term. The useful life is the period of time that that asset is expected to help us produce revenues. An asset's useful life expires as a result of wear and tear, or if the product it makes has gone obsolete and we no longer need that machine. Expense should be recognized and the value of the asset should be reduced over the useful life. Okay, so we bought an asset and we're going to say this asset is going to last us 10 years, say. What we're going to do with that asset is depreciate it. Depreciate it. And this is the journal entry you pray is on the test because it's always the same. It's always a debit to depreciation expense and a credit to an account called accumulated depreciation. So depreciation is a method of matching the asset's original cost against the revenues produced over its life. And there are numerous depreciation methods, which you're going to learn. And in this example, we use the straight line method, which is simple and probably the most popular method used. Depreciation expense is based on the estimates of useful lives and salvage values. What do we mean by salvage value? We mean scrap value, residual value. We bought our sales manager a fancy car. We bought him a big Cadillac or something, big, say a big SUV. And he drives all over the West Coast with that car. And he puts a lot of miles on it. And we figure that that car's going to last us, say, 6 years. He's going to beat the heck out of it. He's going to probably put 250,000 miles on that car in 6 years, right? Well, we have an obligation to say to ourselves, what is that car going to be worth after it's depreciated? And that's called scrap value. And it's an important concept. So we bought him a car for $102,000, okay? $102,000. And we estimate that at the end of 6 years, a scrap dealer will come in here and give us $2,000 to haul it away for parts. That's called salvage value. And when we depreciate, we ignore the salvage value. So let's take a look here. Mitch has those motor scooters. Remember, he bought $4,800 worth of motor scooters, and he thinks that a reasonable useful life is 5 years. So he's going to take that $4,800 and he's going to spread it over the next 5 months. Assume a full month's depreciation is recognized in the month when the asset is purchased. Okay. So he bought this asset June 1st or whatever, and he's going to come up with depreciation expense for 1 month. He's going to take that $4,800, there's no salvage value, and divide it by 60 months. 5 years times 12, huh? He's going to divide it by 60 months, and he's going to come up with $80 per month depreciation. Depreciation. So our journal entry is going to be a debit to depreciation expense, a credit to accumulated depreciation. Let's talk about the book value of an asset. This is an important thing to understand. It's the value carried on the books or the accounting records. Book value for an asset is the original cost of the asset minus accumulated depreciation. Original cost of the asset minus accumulated depreciation gives you what's called the net book value. And that net book value is going to be reduced by $80 every month for the next 5 years until the net book value is zero. Book value, the amount that's undepreciated. And remember, it has nothing to do with the market value or selling price of the asset. Here we go. Accumulated depreciation. Say hello to your first contra account. Accumulated depreciation is a contra asset. What it means, it's an asset, but it's an outlier in that it has a normal credit balance. So when you increase a contra asset, you're doing it on the credit side. So the original cost of the asset was $4,800, less $80 expense. That is your accumulated depreciation after 1 month. After 2 months, it would be 160, 240, 320, etc. The accumulated depreciation is deducted from the related asset account on the balance sheet. And here's your journal entry. You debit depreciation expense and you credit accumulated depreciation. On your balance sheet, you're going to see a line that says vehicle, $4,800. And then below it, it's going to say less accumulated depreciation, 80. Net book value, 4720. Straight line depreciation. Here we go, $80. We debit depreciation expense, credit accumulated depreciation. There's no exceptions to this. It's always depreciation expense and you credit accumulated depreciation. You never, never, never credit the delivery equipment unless you're selling it. That $4,800 is going to be there forever, okay? What's going to go down is the difference between the original cost and the accumulated depreciation. And they're just pointing out that we brought on board here some new accounts for you. You're seeing for the first time. Accumulated depreciation. Notice that this thing goes, the assets begin with 1, and they assigned 185 to delivery equipment. You see what the 185.1 is? That's the accumulated depreciation. The 0.1 indicates it's a contra asset. And there are just a few contras that you're going to be dealing with in the world of accounting, okay? This is your first one. Wages payable, that's a new one. Supplies expense, insurance expense, depreciation. You haven't seen those yet. Post adjusting entries to the general ledger. Post. Well, here's your general ledger. Here's a page from your general ledger. This is the supplies folder, account number 523, huh? Expenses typically start with a 5. Well, we debited supplies expense for $60 in this example, and that brings the balance up to 60. Okay. Hope you can see that. And they're just showing you the posting of some of the entries. Supplies expense, we just looked at this one. We debit 60, we credit supplies 60, and we bring it over to the general ledger. Here is the supplies account being reduced by $60. We had 80 to begin with, so the new balance is 20 bucks. Here is the supplies expense. We increased that by 60. That's your offset. Insurance expense, the same thing. The same thing. We are now debiting insurance expense. We have to recognize that 10-month policy for which we paid $700 computes to $70 per month, okay? So we are going to debit the expense, insurance expense, credit prepaid insurance. And let's look at the last two. Wages payable. That's the $400 that was earned the last 3 days of June, but they're not going to get paid for it until next week in July. So that expense belongs in June, not July. You record expenses when they're incurred, not when they're paid. So again, you have a debit to an expense, $400, and that increased the total payroll from $1,650 to $2,050, and you credit accrued wages payable. That's a liability we need to record. And here's your depreciation number. Debit depreciation expense dash delivery equipment, credit accumulated depreciation dash delivery equipment. And here's what we're looking at. We have a piece of equipment here. We're going to credit accumulated depreciation and debit the appropriate expense. Companies love depreciation expense. They love depreciation expense. And the reason for that is it's an expense that does not involve cash. In other words, you're able to reduce your net income by the amount of depreciation expense. For example, you have a profit of, say, $1 million, but then you realize you have $200,000 worth of depreciation. So your net income is really only $800,000. So you're going to save taxes on $200,000. You're going to save 30%, whatever it is. It can be quite significant. So when companies select the depreciation method, there is a method to the madness. Some choose straight line, others use some accelerated methods. Prepare a worksheet. Where do you see our worksheet? Huh? We are going to introduce you this chapter to a 10-column worksheet, typically in Excel format. It pulls together all the information we need. We're going to enter the adjusting entries, come up with the new corrected trial balance, and prepare statements. The worksheet is not a financial statement. It's typically Excel, not a formal part of the system. Only the accounting people use this worksheet. And it's commonly a 10-column item. And on your test, there's always a couple of questions where they say, columns 3 and 4 on the worksheet represent what? Columns 7 and 8 represent what? So you're going to have that in mind. Once you do a little bit of the homework, you're probably not going to have to think of it again, because there's a real logical flow to it. So let's see what we're talking about. 5 steps. Oh my goodness, 5 steps. 5 steps. 5 steps. Prepare the trial balance. The month comes to an end, and you come in on 7 in the morning, the first day of the closing period, and you run your trial balance. And you know by definition that trial balance is incomplete because it has no adjusting journal entries in there. So first, prepare your trial balance. Make sure it's as correct as you can get it to be at that point in time. Prepare the adjusting journal entries. Put them in the appropriate worksheet column. Add the adjusting entries or subtract them as needed. Let's say debit and credit them as needed to come up with an adjusted trial balance. And then you can do the income statement and the balance sheet. Our 10 columns are the balance sheet, next 2 columns, the adjustment, next 2 columns, the adjusted trial balance, next 2 columns, the income statement, next 2 columns, the balance sheet. Worksheet, they're just giving you some advice on headers. I'm not worried about that. Okay. Step 1, prepare the trial balance before any adjustments. Put the heading on top. They're talking about double ruling and things like that. You don't worry about that. So step 1, the first 2 columns is the original, if we want to call it that, unadjusted trial balance. Next 2 columns, prepare the adjustments. Make sure each adjustment is on the right line as the account name. Identify each adjusting entry with a letter or some kind of numerical code. Rule it down, total them up. So far, what have we done? We prepared the trial balance, and then in the next two columns, we posted the debit and credit adjusting journal entries. That takes us to columns 5 and 6, which will be the adjusted trial balance. So let's have a little fun with this. Take a peek. Step number 1, the first two columns on this thing, the trial balance. You print that out, and there it is. We think this trial balance is accurate as far as it goes. We know we have to make adjusting journal entries. So let's look at those entries. Remember, we said that adjusting journal entries at this point in your learning represent a hunt for unrecorded expenses. So let's see what expenses we're going to debit and what items we're going to credit. Let's start with A. Supplies expense. Remember that $60 worth of supplies? $60. We debit supplies expense and we credit the prepaid supplies. We do the same thing with the $70 worth of insurance expense and we credit the prepaid insurance. C, the payroll accrual. We have to recognize those hours that were worked at the end of the month. Debit that expense, credit accrued wages payable, and then depreciation expense is always going to be a debit to depreciation expense and a credit to accumulated depreciation. Okay. So we looked at the first two columns. We prepare the trial balance, we post the adjustments. The next two columns, columns 5 and 6, we're going to prepare the adjusted trial balance. We're going to look at the unadjusted trial balance and increase it and decrease it accordingly. Debit and credit accordingly. Extend those debits and credits that are not adjusted directly to the adjusted trial balance. Enter the adjusted balance in the appropriate trial balance. If an account has a debit and a credit, you got to subtract. If it's 2 debits or 2 credits, you're going to add, huh? So let's see what we're talking about. I think you can see that by dividing and conquering, this shouldn't be too bad, okay? The hard part is understanding the adjusting journal entries. Once you get this part in, columns 3 and 4, the rest of it is like falling out of a chair. So let's see what we have here. Let's look at a couple, huh? Let's look at cash, $470. Well, I see no adjustment for cash. You're never going to adjust cash. You're never going to adjust accounts receivable. Cash isn't like a supply. You don't go to the safe at the end of the month and count the money and the amount short becomes some kind of expense. So, but look at the supplies. The supplies were 80. We're crediting 60 for what we used. The new balance is $20. Look at your prepaid insurance. 700 minus the 70 credit gets you down to $630, right? Delivery equipment. Remember what we said? The assets never change. The fixed assets never change in value unless you're selling them. And that's a long way from what we're learning. So we have delivery equipment of 48. That's going to be the same. What's changing is we're recording the very, very first month of depreciation, $80. And there we go. And wages payable were 0, 400. Let's look at our expenses. Let's start with supplies. You had 0 supplies expense because none had been recorded. Now you record $60. Here you record the 70 for insurance expense and you bring the totals over to here. Prepaid insurance, 700 on the trial balance. We now adjusted 70. That brings the new balance down to $630. Accumulated depreciation, we had none to begin with. That's a credit, so that increased to 80. Accounts payable, you're never going to adjust that. Capital drawing, there's no such thing as adjustments. And here we go. We have now prepared the adjusted trial balance. So based on that work, we're ready to prepare the financial statements. We can go and say to ourselves, I'm going to draw a line, horizontal line, right under drawing, because I know everything below that line is the income statement, everything above balance sheet. So let's see what happens with this thing now. We've now come up with columns 5 and 6, right? The adjusted trial balance. Now, extend the adjusted balances to the income statement and balance sheet columns. Extend all revenue accounts and all expense accounts to the income statement columns, and do the same thing for the balance sheet, okay? And then we can complete the worksheet. We're going to add up the income statement columns, and we should have a difference between them that represents the net income. Complete the worksheet, calculate the difference, calculate it, add the net income to the income statement debit. This is better taught by showing it to you rather than babbling through it, okay? So let's see what we have. Notice that everything below drawing is your income statement. So all we're doing now is copying these numbers. Every one of them we're copying into the appropriate financial statement. Income statement is here. So let's look at the income statement columns 7 and 8. We had income delivery fees of $8,000. Wages expense of $2,050, supplies expense, phone expense, insurance and depreciation. So your total sales were $8,000. Your total expenses are $3,360. The difference between those two is $4,640. Net income. Net income. That's what net income is, right? Sales minus expenses, revenues minus expenses. So all they're telling you to do at this point is we want to balance these two columns. So we're going to take that difference and put it on the debit side, just add it down, 8,000, 8,000. Now, if we did things correctly, we are going to have the same difference when we total down the balance sheet, except it's going to be shown on the credit side. So we do the same thing. We add our stuff down, and we've got a difference between this and this, comes to 4,640. So we are now going to take the lower number and add it back, 12,020. And we are ready to prepare the financial statements. Come on. And now they talk about methods for finding errors. Again, I'm not going to go into this other than we talked about the power of 9. If you make a transposition error, it's divisible by 9, and that could be helpful when you're doing a little data mining, huh? When you're adding columns and numbers down. And these tips are pretty common sense. Check your numbers, recheck. Journalize the adjusting entries from the worksheet. The worksheet. So what we're saying here is we did the worksheet, and now we're going to write the journal entries from the worksheet. It could be done in either sequence, okay? You can do the journal entries first and post them to the worksheet. Here, they're saying we do the worksheet first. The worksheet helps the accountant organize the end of period financial information, including the adjusting entries. The accounts are not adjusted until a general journal entry is made and posted. So let's see what we have here. Here are our adjusting journal entries. We should be pretty good with them right now, huh? We debit supplies expense for 60. That's $70 a month insurance policy. The $400 of a couple days at the end of June labor, and the depreciation expense. And up here, they're having fun with colors. Okay? They're just showing you which items got adjusted. Explain the cash, modified cash, and accrual basis of accounting. I am not going to do that. We are not going to teach you the cash or modified cash bases of accounting. They are not GAAP approved. They do not produce accurate financial statements, and any business that says they're going to run on a cash basis is going to cash basis themselves out of business. Okay, so we're not going to talk at all about cash, modified cash, nor will there be any questions on the test about the subject. If one or two questions happen to slip in, you'll get credit for getting it right. We teach the accrual basis of accounting. If the auditors come in and they see you're working on a cash basis, they're going to make you redo all the financial statements anyway, basis of accrual basis. Nobody with a cash-based business can borrow money, attract investors, get interested buyers. Accrual basis of accounting. Revenues are recorded when earned. Expenses recorded when incurred. Recognizes receivables and payables. This is the best method of measuring income for most businesses. Smaller service organizations might use cash or modified cash. My brother-in-law back in New Jersey, my sister's husband, he has worked in his family business forever. They own a couple of gas stations, a pizzeria, auto parts stores, and I remember talking to him a couple of times. They say, "Artie, how much money are you making there?" And he said, basically, at the end of the week, they just empty the cash register. They set aside some to pay a few bills, and whatever there is what they're paying themselves. Well, they're on a cash basis, it looks like, but they don't care. That business is self-sustaining. They know exactly what's going on. They're never going to worry about borrowing money. So that would be one maybe example. Cash basis, cash, modified cash. I'm deliberately skipping these slides. Okay. I am briefly going to go through this appendix. Okay, we need to get our appendix out here. It just shows some of the other depreciation methods. Okay, and I'll check with Cornelia if we're going to test on this. But let me just show them to you. You're going to be seeing these like crazy when you get to 230. Straight line method. That's the one we just used. And there's one called sum of the year's digits, double declining. Or there's different ones. Here we have salvage value of $4,000 on a $40,000 van. Remember, we don't depreciate the salvage value. So the number we're going to depreciate is going to be 40,000 minus 4,000, $36,000. And we take that 36,000, we divide it by 5. It turns out to be $7,200 a year. Straight line. And here's the straight line schedule. Notice the depreciation expense is the same each period. That's why it's called straight line. And the accumulated depreciation increments by 7,200 until you get to the final net book value of 4,000. You can never depreciate an asset below the salvage value. I'm just going to show you this one for fun. Some of the year's digits. I've never seen this in the workplace myself, but I remember learning it in school and on the CPA exam. Some of the year's digits, huh? We have a 5-year item, huh? This is a 5-year asset. So we're going to take the sum of the 5-year digits. 5 plus 4 plus 3 plus 2 plus 1 equals 15. So the depreciation expense the first year would be 5 over 15 or 33%. So this is an example where you're top loading the depreciation expense. And notice here, the depreciation expense gets smaller and smaller each period until you come down to the same 4,000. Double declining balance. Now this one is used a lot. You have a van with a 5-year life. The straight line rate is 20%. Double declining balance means double the straight time rate. So this van is 1/5 or 20% a year. Double that. It becomes 40% a year. 40%. So what this one does is it really top loads, front ends the depreciation. You have a balance of 40,000 times 40% equals 16,000. Wow, look at all that depreciation. That brings you down to a net book value of 24. 24 times 0.4 is 9,600, brings you down to 14,400, etc., etc. And that is the end of our presentation today. Friday, we'll go into chapter 6, which I believe, yeah, we got to go into chapter 6 on Friday. I was thinking of a different chapter. Yeah, chapter 6. And then you're going to have your first test in the form of 2 sittings. And we can use Monday's class for a good review. And I think Wednesday's class will be available for a good review of this material, okay? In the meantime, you know where to find me for tutoring. I had a couple of people pop in last night just to say hello. They wanted to see how the tutoring is going with other students, but I didn't have anybody else. And by the way, Cornelia cordially invites you, any of you who wish to come to campus today, you know, parking is free on the campus right now. Come to campus. We're going to have sandwiches and chips and a little soda and just a little get together. She thinks it might be nice to meet the teachers in person and talk a little bit, what's going good, what's not. Trying to lend an aura of sociability to this Zoom world we're in right now. Okay. Anybody have any questions, any comments?
Thank you for your time.
Well, thank you very much. Should we close the meeting, Justin? Or?
Sounds good.
Okay. You take care, everybody, and we'll see you on Friday.
Thank you.
Bye-bye.